Greetings, everyone. Wanted to send this quick market update out. As I record this, it's Tuesday at almost noon, I guess. So who knows how the markets are going to end today, but I'm sensing a little bit of fear, I guess, a lot of questions. There's obviously a lot floating around in the news headlines. We have the implementation of tariffs today, and so anyway, I just wanted to share some thoughts. Really, right, this is actually a pretty full and interesting week for the markets. We have the tariff implementations today. We have the Treasury Secretary speaking to, I think, the New York Economic Club on Wednesday. We have an important jobs number on Friday, and then also Chairman Powell will be speaking and making comments on Friday as well. So this week has a lot of factors that could make it a little bit more volatile than maybe normal weeks. So that's the first thing that I would share with you. But I wanted to prepare a couple slides that I want to share. Okay, and really, let's talk about going back to our original expectations for this market this year. If you go back and view or read our market update in January, this is one of the slides that essentially summarized some of the things that can and likely to impact the market this year. Inflation, obviously tariffs can impact inflation. We still expect that the inflation will remain tame. If any of you can tell me where these tariffs are going, what the Trump administration will do, how long, I don't think anyone really knows. I think Trump likes being unpredictable, and he uses that to his leverage in negotiations. So I don't think anyone knows how long these tariffs are going to be and what the actual impact is going to be. I would caution you to avoid kind of drifting to the far end of, wow, this is going to lead to complete economic slowdown and recession, et cetera, because frankly, we just don't know. Second thing, financial conditions. Financial conditions are still good. We'll see how the tax legislation comes through Congress. Trump has an address to the joint session of Congress tonight at 9 p.m. I guess it's not technically called a State of the Union, but it's essentially kind of what it is. And so there's a lot to cover there, and we'll see but it's more likely that we think the tax cuts will remain in effect, at least for probably the next 5 years or so, but we'll see, again, how all the legislation pans out. Mortgage rates, let me come back to this because there's some interest rate implications to some of the things going on. You know, we did talk about tariffs and deportations as a potential negative to the market and having market impact. DOGE as well, right? So the cuts that are being made to spending, some of the fallout, some of the government layoffs and all that's going on there, that is a negative impact. And it's something that we kind of mentioned as being a potential negative impact. Corporate profits, we've just come through the latest corporate earnings season. Earnings are still good. Capital expenditures are still pretty good. And then sentiment, I'm going to come back to that in a minute. So if we look at one thing I'll remind you of, we've just come out of 2 straight years of really great market returns. And this is a slide we showed in the January seminar that those 2 years were really some of the strongest since 1928. So I think it's fully reasonable for us to expect a little bit of sloshing around and a little bit of consternation, I guess you could say, this year in the markets. That doesn't mean we run for the hills. It doesn't mean we make huge changes. It just means we probably should remain patient. But here is one thing that, so there are some forces at play that potentially could indicate some economic slowdown. And I'm actually going to tell you why this is a good thing in a minute. But so capital expenditure expectations in the most recent Federal Reserve surveys are for a drawdown or a lesser amount of corporate capital expenditures. In other words, corporations spending money on new projects and investments, etc. This does have recessionary implications. If corporations are less likely to spend money, all that trickles down. The main reason is that a lot of corporations are just trying to gather an understanding of what the not only economic landscape, but really the political and the regulatory landscape. Because every day it seems like there's something new coming down the pipe, and there's just so much that has been thrown from the political side of things, between executive orders, tariffs, DOGE, all this stuff. And so I think companies, rightly so, are probably saying, let's just kind of hold off till we get a little clarity here. And that's something that's going on right now. One thing I will remind you of, I've shown you this chart multiple times. And if you look at this chart, down here at this very bottom, that is October of 2022. This is the S&P 500. And we've been in a clear bull up market since that time. Now, until we truly get a trend change, in other words, the S&P 500 kind of falls below this whole trend, there's reason to believe that the bull market is still intact. Now, if you look at the most recent move here, okay, yes, we've had a pretty significant drawdown in a very short amount of time. In fact, some of you might be blown away to think this. It was 1 week ago today, last Tuesday, February 27th, I believe, maybe 26th, that we had new all-time highs for the S&P 500. So how quickly emotional and the sentiment can change. We literally had new all-time highs 1 week ago today, and here we are talking about a little bit of fear and coming into the market and recession fears, etc. Now, I don't see anything. In fact, I think this is a pretty good thing because this is fleshing out some of the excesses that get built up in bull markets, and it puts us back on a little bit more of a solid playing field. All right, the other thing that I will draw your attention to is we've talked about cash on the sidelines before. So this is an updated chart, and cash continues to increase. So both institutions and individuals are simply allowing cash balances to increase, either through selling or redeeming assets like stocks and such, or through income that they just haven't put to work yet. This is a good sign, okay? In bull market tops, you would tend to see cash dwindling because everybody's getting euphoric about putting money in the market. This is still a good sign. And in fact, in the last 4 weeks, almost $100 billion has been raised, or cash growth has been done. Now, investor sentiment. I've talked about this a lot over the years, and it is truly a litmus test, okay, to see where we are in some kind of cycle. The investor sentiment number, so this is the AAII, I've shown you this before, this is the most recent survey, and this is pretty remarkable. So if you look at the most recent survey ending February 26th, again, that was around the market highs. This is really even before a lot of the sell-off we've seen the last few days and into this week and potentially the rest of the week. So over 60% of respondents felt that we're in a bearish environment. In other words, they think the market's going to go down. And the relationship between the bearishness and bullishness is actually a net bearishness number. If you take those two numbers and kind of net them out, it's a net bearishness number, okay, of negative 41.2. So when you compare this to historical patterns, okay, when we've, based on when that survey has been around, when we've had this net bearishness of similar numbers, okay, essentially over 40, look at this data. This is pretty remarkable. So anytime we've gotten to this level of net bearishness, look at what has happened to the market 3 months after, 6 months after, and 12 months after. And what this tells you is that based on historical data, when we get to these levels of bearishness, the win rate, in other words, the amount of times that the market was actually higher 6 months later than that survey is 90%. And 12 months later is also 90%. So if you look at history, if you look at statistics, yeah, there's actually a pretty good chance that the markets are going to be higher 6 and 12 months later than they are today. Now, doesn't mean we're going to just go up from here. We're probably going to go through some consternation, some challenges. But this is a pretty good indicator, okay? And if you look at the actual average returns, they're pretty remarkable. Now, I'm not necessarily forecasting that, but I do think that, again, we're not at a point where we're at these market peaks, in my view, that we need to be just really making some drastic changes, okay? So remember, when emotion runs high, logic runs low. And the more news headlines you see about Zelensky, about Trump, about Doge, about tariffs, you name it, deportation, Russia, whatever it might be, those are all tiny emotional deposits that get placed, okay? And the more emotional deposits, negative specifically, that you receive, logic starts to diminish, and we start getting a little bit irrational. So let's focus on, the plan at place, and always evaluating, the circumstances around us. We don't turn a blind eye and stick our head in the sand. But when you look at where we are, we don't think we're at the end. So remember, I've shown this a number of times, the cycle of emotions. You're going to have these mini cycles even in these long cycles. And so we're going through a mini cycle of a little bit of anxiety to denial to fear, and who knows where we go from there. But now's not the time to head for the hills. Truly believe that, yes, I do think that the market's probably going to be pretty choppy here for a little while, especially this week. But here's maybe the net positive that comes out of this. I just told you about tariffs, inflation, economic slowdown, etc. And all those are real possibilities. In fact, I'm very interested to see what the job number looks like on Friday. However, let's think about what the response might be, in particular, from the Federal Reserve. So it wasn't long ago I shared that we may not get a whole lot of Federal Reserve interest rate cuts this year. But if the Federal Reserve starts seeing some cracks in the armor of the economy, some slowdown, guess what they're going to do? They're going to potentially be stimulating or interest rate cuts. And what happens then? Well, one, the market likes that. Two, economic activity increases because lower rates means additional borrowing, mortgage rates coming down, etc. And then the other part of this is, some of the internal market, prognosticators and all the smart hat people talk about something called the Trump put. All that simply means is this. You have to remember, we have a little bit of a precedent on Trump's responsiveness to different types of conditions, particularly market conditions, because he was in power for 4 years from 2016 to 2020. And one of the common litmus tests that Trump uses is the stock market. So there's this implied level of thought, and I tend to believe this as well, is that, yes, Trump's going to talk tough on tariffs, we're going to implement tariffs today, etc. But the moment the market really starts cratering and having a lot of troubles, that's not something. Trump views part of his success as the stock market and how it performs during his presidency. And so we think it's unlikely that Trump would allow all of these pressures to really sink the market. So there's this Trump put at place. In other words, this underlying support that from a executive level, presidential level, he's not going to let his actions really sink the market. It's another thought flying around. I tend to agree with that because if you listen to what he says, particularly over the years and how he campaigned, the market is a litmus test for him. So I say all that to say, we believe it's time to stay the course. In September of 2024, so 4 or 5 months ago, we did make some fairly significant portfolio adjustments, particularly in the IRAs and all the non-qualified assets, the non-taxable assets. And at the time, we took a little bit of money off the table in some of those momentum stocks. Like, if you notice, a lot of the portfolios we run, we've owned NVIDIA a long time, we've owned Broadcom a long time, and Microsoft, et cetera. All these stocks have done extremely well. And in September, we started looking at, let's maybe kind of pare back. It's just good portfolio management. Didn't get rid of them. Doesn't mean we don't like them anymore. But what it does mean is, at that time, we were somewhat preparing for potential market consternation and volatility, particularly in those technology or the momentum names. And that actually it didn't play out for a little while until, the last month or so or somewhat this year. So we're actually, I think from our perspective and the portfolios that we manage for you, in a pretty good position. I think that the steps that we took in September were somewhat preemptive to what we're going through now. The other thing I'll tell you is if you have cash on the sidelines that's outside of our management, now's the time for us to have a discussion about, okay, are we getting towards areas, remember that chart I shared, getting towards areas we're somewhat getting lower in that bull market uptrend. And those are typically the times you might want to put a little money to work if you have it on the sidelines. So if you've lasted this long, thank you, but I wanted to make sure we communicated well, at least about our market thoughts and some of the things going on in today's news headlines. And so I thank you for that. If you have any questions, always please reach out to us, and we'll see you soon.